So first of all, thank you so much for doing this Zoom call. I know you're bombarded with a lot of these calls and webinars during this time. I'm sure in
I
terms of
know,
asking
yeah.
for five,
But it's always a
right?
pleasure chatting up with you.
Thank you. And I feel, I mean, for those of you who are not very familiar with Sundar, Sundar's written two amazing books in the financial space. Both are, in some sense, the top 10 books to be ever written for finance in India. And Sundar runs his own consulting firm, uh, has been in the financial space for the last 25 years, worked with Kotak. And now I think you provide a lot of services across the board, right?
That's right.
Whether it's on the funding side of things or
Yep.
I mean, if you want to elaborate a little bit on that, I think that might help.
Yeah. What I do is not only help companies become financeable, but also mobilize money for them. And the money could be debt as well as equity. A large part of equity is happening for startups, and debt we do it across companies, right from the richest in the world who are Indian, right down to small startups. We mobilize debt for all of them.
Nice. Um, that's cool. And so the reason why I wanted to talk to you was we've been talking to a lot of these other experts in different areas, and
Mhm.
COVID, in some sense, is taken over our lives, right? Like it's making us do
Absolutely.
things. Yeah, it's making us do things I think we've never done before. But and we spoke to someone from a relationship standpoint and how dating is changing now because everyone's online.
Mhm.
Uh, but there's one area, obviously, that I think that's kind of is pervasive to the world is finance and financial investing. So I'm curious to get your take on how are I guess, overall, how are the financial markets looking pre-COVID and then post-March 24th? What are some of your observations in terms of the stock market or the sectors that have been hit pretty badly?
Yeah. Okay. I guess one should probably start off on the economic front and then build it up into the markets. And
Sure.
a lot of people were otherwise comparing it with what was called the great financial crisis of 2007 2008. And if one is to look at the current context vis-a-vis what it was in 2008, 2008, the finances of the country were in a much better position. Okay, so therefore, the government was in a position to spend a lot of money to boost the economy. And that sort of ensured that we didn't face a major brunt of whatever was happening globally.
Mm.
That's what is absolutely different now, because even going into the COVID problem, the government finances were massively stretched. And therefore, the current situation where the economic activity has almost completely stopped. Now, what happens
Mm.
when economic activity is stopped is that people don't have purchasing power. We are talking
Right.
of a poor country, lot of daily wagers. People don't have purchasing power. They stop buying. When they stop buying, the economy goes foot. That is the
Right.
kind of a thing we are looking at now. And that is where the government will have to spend money. The problem is of where does it find the money to spend? Because a lot of money has already been spent. In fact, very coincidentally, I was looking at numbers.
Mm.
Uh, Last year in August, the government had taken money from RBI. You know, there was a committee which said that, which evaluated RBI's reserve position. And then they said, no, RBI has got more reserves than it needs. And then 1.7 lakh was transferred by RBI to the government.
1.7 lakh crores.
Absolutely. 1.7 lakh crore is what was transferred last
Right.
year around August, September. Okay. Which sort of helped the government give a, a, a not so bad picture of the finances last year.
Okay.
Okay. Very coincidentally, if you see the first stimulus package which has come this year, post-COVID, from the finance minister, the amount is exactly 1.7 lakh crore.
So what does that mean?
What that means is that now is when a lot of criticism will come up for the money having been transferred last year. Because honestly, the reserves that RBI had was for contingencies like this.
Okay.
Okay. Now, when your problems were not external, the problems were internal in terms of how our finances were. At that stage, when we not borrowed, we used up the money from RBI. Now, when you've got a real problem, a real big problem, then we find that the reserve pool which is there with RBI has been diminished to that extent. Okay.
Right.
So, but the good part is that RBI has built up a lot of reserves over time. So, it's not that a similar thing cannot be done. And what we are now looking at is perhaps RBI itself needs to perform a role which is very different from what it would normally do. Like an RBI would never, for instance, get on to funding private sector.
Right.
Okay. Now we are probably looking at a situation where RBI might need to take those kinds of positions. These were
So
the kinds
Sundar,
of, yeah.
right. So now you said 1.7 lakh crores has been taken from RBI by the government so that it can be utilized this year, right?
If I
Post-COVID.
were to use officially correct language, government didn't take it, RBI distributed it to the government.
Okay. Okay. All right. It's important. It's important we use the right
Yeah.
words here. But so if RBI has distributed that amount to the government, I honestly haven't heard any news of where that money is being dispersed. As in, what is it being used for? So, do you have any
See, it
information or
was
light on that?
last year's transfer was essentially meant to manage the overall fiscal of the government, number one. And then there was a lot of commentary saying that RBI has been boosting the balance sheets of banks. Banks also have been suffering this problem of non-performing assets. Their capital has been getting eroded. So the government has had to recapitalize some of these banks. Some of the commentary said that, look, this kind of a transfer only helps the government to recapitalize the banks. So in a way, that becomes a kind of a justification.
Interesting. Okay. So how long can we go on as a country?
I would put it this way, that somewhere down the line, we need to learn to pass on some of these decisions down the line. You can't have a single policy for the whole country. You will have several pockets of the country where there will be no problem, and there will be other parts of the country where there will be a problem. You can't have a blunt hammer with which you cut down everything everywhere.
Yeah.
And hoping that that thought process will creep in sometime, and thereafter you will start seeing at least smaller areas which can afford to maintain social distancing. Because let's not forget, the final objective is to maintain social distancing. The final objective is not to shut down the economy.
Right.
So parts of the economy which can function without any issues in terms of social distancing, I think those kinds of things will start operating. It's a question of when the government chooses to take that call.
Right. So according to you, to make sure this economy doesn't fail or collapse in some sense, what are some of the sectors you think that should be kicked up or switched on straight away?
Okay. See, I would see, first of all, the parts of the sector which are going to get badly hit are essentially businesses which are high on fixed costs. The high on fixed costs could be on account of operating costs or financial costs. The financial cost, I mean borrowing. Okay. That's where And then you've got a set of industries like hospitality, like airlines, where there is also going to be a consumer change, the consumer behavior change. People may not want to travel that much. People may not want to enjoy a holiday for the next 1 year or so. So
Yeah.
those are industries which will also face a hit from the consumer end, but even other industries which may not get a hit from the consumer end, they may still have a problem in terms of, how many companies can afford to survive months together without a top line.
Yeah.
Okay, so uh, the big companies with deep pockets will survive naturally.
Mm.
The small and medium enterprise of the country, which is where 90% of the employment of the country is. The organized sector is hardly 10%.
Mm.
90% is unorganized. That is the sector which is going to get very badly hit. That's the sector which has had one hit after another. It was first demonetization, then GST, and now this, of course, was an uncontrollable thing as far as we were concerned. So thanks to all that, I worry about that SME space, because if that SME space goes for a toss, then it's going to be social havoc, because you've got so
Mm.
many people down on the roads without a job, not knowing what to do. And that's where the government has got an unenviable position. On the one hand, they don't have money. On the other hand, it's easier for them to handle the large companies. What I mean by that is that, see, it's difficult to get an RBI to take a risk on absolutely financially weak companies. So
Mm.
if we have to get onto a mode where we use RBI's balance sheet to support a revival, it's going to be very difficult for RBI to take a stake, not take a stake, but take a credit risk on any of these financially weak companies.
Right.
So the flow of money might go back to, the AAA rated kinds of companies, the very good companies, which otherwise might have the balance sheet strength. So money might flow into them. Once money has flown to them, then people who are part of their value chain, those kinds of businesses, they will
Mm.
still survive. It's those standalone companies which are not part of the value chain of large companies. I don't know what can be done for them.
Mm. That is true. So now,
And that's where
that's what.
actually the one thought that I have been grappling with is that the at times things have to start with a fundamental thought process. Okay. The fundamental thought process needs to be that, look, all this capacity which exists all around, it all belongs to the country. So I need to support it. That's one kind of a thought process. A
Sure.
second kind of a thought process is what a pure economist would say, that, look, these are all inefficient. It's only the large which is efficient. If this whole thing helps in finishing the small, then it can only be good for the economy. That is that a pure economist, if I were to add without a heart, that's what that thought process would be.
Mm.
Okay. Now it's time that we started looking at it as this is production capacity of the country, and this production capacity is backing up 90% of labor. Once that thought process comes up, then a whole lot of policies flow from that. For instance, the trouble for these companies is, how do I manage fixed costs?
Yeah.
Can we have a mechanism where a certain percentage of the fixed cost of these businesses is supported by the government? You
Right.
know, those kinds of measures may be required to bring business on. With a lot of hesitation, we got on to this 1.7 lakh crore package, which frankly it includes a lot of existing programs. So it is not a COVID specific incremental expenditure. There was
Right.
already a program based on which the poor have to get 3 kgs of grains. You make it 5 kgs of grains. But
Hmm.
the entire 5 kg of grains is not a COVID package. It is only the incremental part of it is the COVID package. So I'm still
Yeah.
to see any kind of a significant outflow coming in out there, which, as I said, is because the government's own finances are stretched. And that's why they'll have to come out with a lot of unconventional mechanisms of doing it. Because once again, if the government stretches it too far, the government goes on to blowing money, as some of the commentators are saying, that look, this is a time we shouldn't bother about fiscal deficit and things like that. See, you
Hmm.
don't bother about fiscal deficit. What will happen is that all the international investors will get worried about you as a country. They
Right.
will start pulling out their money. Once that process starts, your rupee will start crashing. And then
Yeah.
it becomes one vicious cycle. And then you will find that you have an external reserve problem. Now,
Yeah.
again, fortunately, RBI has got a good $415 billion of reserves. So,
Hmm.
even if 100, $150 billion were to go away, we will hopefully not reach the stage we were in 91, where we had to effectively pledge gold of the country to get some foreign currency in.
Hmm.
So, thankfully, we are in a stronger position as compared to 91.
Very interesting. Um, so, Sundar, actually, one last question around this, and I guess maybe then I want to get into maybe the stock market a little bit. But
Hmm.
according to you, how long can we go on? If
Mhm.
there's a date, like if you had to say, okay, we could potentially do this whole lockdown thing only till end of May, because after that, then the economy is going to collapse.
See,
So,
before the economy blasts, I think people will start blasting. Okay,
hmm,
because honestly, you can't hold people like this for too long a time. You've got all those
right,
migrants in the border who are probably looking forward to either coming back to where they were earlier or going to their villages, which was their destination.
yeah,
The current context, they would probably prefer going to their destination. But now they are in like, if I were to use the word, they might be feeling like refugees. They are
hmm,
neither here nor there, and for an unpredictable time frame. So I think tempers will start fraying, and we need to manage that human aspect of it as well. The disease aspect of it is one, but once again, we need to be clear that we are managing the disease so that the humans can be managed.
yeah,
That becomes important. But in
yeah,
terms of the economy itself, I would say that for see a few sectors will recover very fast. Okay, like your food sector,
hmm,
food and fast moving goods sector. Unlike your hotels and travel and things like that, which are discretionary, which people might choose to postpone. Similarly, consumer durables, people might choose to postpone. But food, FMCG, etc., people will have to start consuming.
yeah.
So those might be the first to go off the block. Many of them are
Okay,
operating now, but still they are operating at maybe 20%, 25% kinds of capacities.
true.
So it will probably take 3 months, 4 months for them to get on to 100% capacity. For consumer durables, see, the fact of the matter is that a lot of consumer durable purchases are financed, which means you need financiers there. In
Hmm,
a situation where financiers will be worrying about recovering money which they have already lent, and their balance sheets will keep taking a knock, how do they lend you money? So therefore,
right.
consumer durables might take a very long time. And
Give me
real
an
estate,
example of a consumer durables company.
I'm talking of something as basic as TVs, fridges, etc.
Okay.
Okay, and real estate, though, in any case, it was on life support.
True.
Okay, now I think the life support can be withdrawn and used for something else which can at least survive. real estate is like finished now.
That's actually unfortunate. A lot of people because at this point in time, people will also want to kind of liquidate, right?
Absolutely.
And
True.
nobody has money. Nobody will want to invest in
Nobody
real
has
estate.
money.
Unlike,
And the problem which
yeah.
comes up when assets go down, like here we spoke of real estate going down. Let's look also at stock markets going down. The problem which comes up when markets go down is that the what we call as a wealth effect comes into play. The people feel that they are now losing wealth, and it's not feel; it's a reality. It's a
Yeah.
value in the market which is going down. When
Yeah.
that wealth effect kicks in on the negative side, that again causes a consumption decline.
Which we're seeing right now.
Yeah.
Yeah.
And which is why for the government, the key thing is how do they keep the consumption going? I think that has to be the crux, because if you are able to keep the consumption going, the industries will be working. If the industries work, employment will be on. If employment is on, then earnings are there. There is a virtual cycle which is there. The government will have to see how do I get that virtual circle on.
Well said. So in terms of you spoke about the stock market. So I obviously feel a lot of people don't have a lot of liquid cash to be investing, but let's say there is somebody who has uh, money to invest and they're looking at an opportunity right now to, let's say, make some money out of the stock market.
Yeah.
Should we potentially look at only blue chip companies because of just the things that you mentioned? Because most, even if things went really south, like maybe the RBI, the government could like bail them out. Is that like what should be maybe some of the things that people should look at if they want to invest right now?
Let me start with one level higher before we get on to equity itself. Typically as asset classes, we talk of debt, equity, and gold.
Right.
Okay. And people keep complaining, including Warren Buffett, keep saying that gold is a stupid asset for people to invest in. And in one of my books, I've incorporated a chapter which says why Warren Buffett is wrong, at least as far as India is concerned. Okay. Because gold prices in India are set based on the exchange rate. There is a price of gold in the international market. It is translated into Indian rupee, and that is how gold trades in the Indian market. So when you've got trouble in the Indian country, first of all, when there is trouble globally, there is a flight to safety. And when there is a flight to safety, gold has that perception of I at least have it with me. Unlike all debt and equity, everything can go down to zero, but gold I can at least hold on to it. So there is a flight to safety to gold, which normally pushes up the price of gold even internationally. Okay. Added to that is this impact of this currency, because given the whole economic context, the rupee will have to depreciate, and when the rupee depreciates, then the price of gold in Indian rupees will again go up. So the gold is typically mentioned as a safe haven asset, and it is precisely for these kinds of situations that one would always advise people keep some 5%, 10% of your overall portfolio in gold. That's one part of the whole thing. Now let's look at debt versus equities. I myself have trained tens of thousands of industry professionals on how debt is safer than equity.
Right.
Now I find myself in a very odd situation where I'm actually saying equity is safer than debt. Okay.
And what's your rationale behind that?
Yes. Because with debt, see, today, honestly, you don't know which borrower will not be in a position to repay his money. And we are not talking of triple B kinds of companies. We are actually talking of very highly credit rated companies. They may not be inherently a bad company, but top line goes off for 3 months, 4 months, they don't have the liquidity to repay. So the
Right.
next round of defaults, you don't know where the default will come from. So therefore, debt I am now seeing as very risky at this point of time. Unless it's debt from some top 10, 15 companies or a government and things like that, the rest of the thing I'm finding debt very risky. And on the other hand, I'm seeing equity prices have crashed, and we are probably reaching a stage where this might be a once in a lifetime kind of an opportunity to just invest for the extremely long term, saying that look, these are companies which will survive whatever problem comes up, and when they survive and when the overall environment improves, these companies' valuations will improve. So whatever I
Right.
can do, let me park it in them and let me not even look at those prices. I will look at those prices 5 years down the line and say that, boy, I actually made a good investment. Because what could happen is that markets might go down even further. One is not ruling that out. Because
Sure.
depending upon the kind of news which flows through, both in terms of spread of the virus as well as what happens in terms of company performance, economy, etc. Based on the flow of news, the markets can be weaker as well. Okay,
Right.
but then you might never get a completely bottom of the market. So whoever has got monies, I think people will have to start investing. Market goes down further in the next few months, maybe invest a bit more. And then investing on a more than 3 years, 5 years, I am not going to ask what the price of that security is. I know the company will survive, and therefore I will earn bumper returns out of this investment. With that kind of an approach, I think people can invest. And for the reasons that I mentioned, I think that people should start taking their money out and start looking at equities.
So even if, let's say, so that now, um, let's say a lot of people invested in fixed deposits or mutual funds, right? Which
Right,
is
right.
in some sense debt.
Yep.
Uh, now, people, I'm assuming, have lost money,
Mhm.
uh, and let's say they've lost 25, 30% of the asset value, right? So now I'm
Yeah,
curious, would you tell them to say, okay, let's say initially I had 10 lakhs and
yeah.
now it's become 5 lakhs, but
Mhm.
still take out that 5 lakhs and then reinvest in stocks? Or is it the
Absolutely.
liquid? Yeah?
Absolutely. Absolutely. And I would say that look, if you don't know the market, don't invest directly. Again, go through a fund. Even if it means taking money. And now is when the difference in liquidity between a debt mutual fund and a fixed deposit will now stand out. Because your debt mutual fund will still look at giving you your money. Okay.
Mhm.
Fixed deposit, you're going back to the company and the company itself is been facing its own troubles. So debt mutual
Mhm.
funds, depending upon how many people come to ask for that money, until there is a complete run, which hopefully doesn't happen, at least people can get money out of their debt mutual funds and they can park it back into equity mutual funds.
Okay, interesting. Okay, so now, uh, what are some of the, okay, so let's say there's some liquid cash to play with. How would
Mhm.
you recommend? So you're saying, does it make sense to invest in equities directly or look at funds, like look at
Funds is
mutual
the,
funds which are equity focused?
absolutely, funds is the best tool. Now, there again, when it comes to investment, see, first of all, I think I also need to add this rider that this is not investment advice.
Sure.
Okay. Now, having said that, if I were to look at it as which are the avenues in the equities market which might be quote unquote safer, I would say food and fast moving consumer goods for the reasons
Okay.
that we discussed. I
Mhm.
would say pharma, okay,
Okay.
and I would say foreign. Very coincidentally, these are all the first: the foods, the FMCG, the pharma, and the foreign. The four first make sense. Foreign for the reason that if the rupee were to depreciate, then they would get the benefit. Let me elaborate on that. For argument's sake, if you had invested in shares of Google, or I would say Alphabet now. If you had
Okay.
invested in Alphabet,
Hmm.
and even if Alphabet share prices did not move $1,
Okay.
but if the rupee moved from 75 to 80, your $1 out there has moved from 75 rupees to 80 rupees.
Hmm.
Okay, so that play on the currency is, I think, something people need to look at, because to me, at a very economic level, there is no way that we can continue with this kind of value of the rupee. Because ultimately, for boosting the economy, you will need exports. If you
Yeah.
need exports, then your products need to be competitive. If on the one
Okay.
hand, because the government has to spend a lot of money in the local economy to boost consumption and all that, it can actually create inflation. So the moment there is inflation, and if your inflation is more than your competing country, your products have become less competitive in the
Right.
global market. So how do you correct for that? You'll have to make the rupee weaker. Okay.
Hmm.
And once again, as we discussed earlier, if international investors pull their money out, once again you will see the rupee depreciating. So the play on
Yeah.
that is to have an exposure to foreign investments, and that's where again you have got mutual fund schemes, which operate on a mode where they receive money in rupees out here, and then they in turn invest abroad. So therefore, the underlying investment exposure is abroad, and that is how that international investment exposure people get by investing in rupees in those kinds of local mutual fund schemes.
So, so there are mutual funds that are focused towards each of these sectors, or a mix of these sectors, which you mentioned:
Absolutely,
food, FMCG,
absolutely,
pharma, and for.
absolutely.
Okay.
So you've got some specific, see, even amongst mutual funds, you have got some funds which we call as diversified, and then you have got what we call as sector funds. So you've
Hmm.
got funds which are focused on healthcare, focused on pharma. So these kinds of funds can work out. I'm still not a great fan of what we talk of today as diversified equity mutual fund schemes, because the diversified equity mutual fund schemes, most of them tend to have very large exposures to the banking and finance space. And I think that is the space where there's going to be a bloodbath in the next few months.
Hmm. So, I'm curious now. Obviously, you mentioned like in terms of foreign investments, right? Like now, let's take China.
Yes,
Do you feel because of just all this? I mean, it's unfortunate. Like some people are calling it the
yes.
Chinese virus,
Chinese
and
crisis, I know.
right, and
Yeah.
Trump called it the Chinese virus a few times. But do you feel that
Yes.
is there a psychological effect where
Mhm.
uh, you're seeing countries saying, "I don't want to trade with China anymore" as a result? I mean, I've
Okay.
heard, right? I heard
Let
Japan.
me put it this way. Companies are hardcore capitalists. Okay.
Okay.
Today's situation where China, because frankly, because of its own political system, has been able to come back. I hear percentages of 90% and 95% in terms of manufacturing levels as compared to what
Hmm.
it was earlier. Okay. Now, if my country allows me to manufacture, and
Hmm.
if my supply chain entails taking goods from China, okay, as of now, I would still go ahead and take goods from them. I'm talking as a capitalist, the thought process which would be there in 99 out of
Right.
100 companies. Okay.
Yeah.
Having said that, in a strategic kind of a way, companies have recognized the problems associated with too much of a focus in terms of their supply chains. Okay.
Hmm.
China, because of cost competitiveness, was driving several industries. And many companies had too much of exposure to China in terms of their supply chain. So, in a strategic kind of a way, companies will gradually reduce the role of China. And that is where maybe some of the other countries might benefit. So China's role in the global economy might actually go down thanks to the virus, and maybe some other countries might benefit from this whole thing.
And the ripple effect or the trickle effect of it, do you think as a result India might benefit as a result?
Okay, let me put it this way, that India should stop believing that because something is going out of China, it will come to me. Okay.
Right.
Because all said and done, now that there will be more focus in terms of risks and geopolitical risks, fact is everyone knows that India and China is a relationship. It's a very complex relationship.
Right.
So if there's any kind of a trouble, then companies will again find that in terms of their value chain, they are stuck with two companies who are in trouble with each other in any case.
Yeah.
Okay. Added to that, the kinds of policy troubles we are facing now. So if we handle the policy well, then we might still get some benefit in terms of the pass on. But otherwise, if I were to go back in terms of history, then maybe some of those erstwhile, what we were calling it as Asian tigers, I think Korea is going to be a big beneficiary of this whole thing. Because Korea also demonstrated how well they got out of that COVID so soon, despite being the second country to be affected.
Yeah.
So Korea is going to be the biggest beneficiary of this shift out of China.
Okay.
And then we might have dark horses, because unnoticed by most people, countries like Bangladesh have been inching their way up in terms of the export footprints. Okay. So some of this pass on from China might even get on to a Bangladesh.
Yeah. Very interesting. That's pretty much it, Sundar. I feel like, I mean, obviously I would love to ask you more specific questions in terms of within these sectors, like when you spoke about the 4 Fs in some sense, right? Like food, FMCG, pharma, fund, like are there certain companies that
becomes difficult to talk about, because then from a regulatory perspective, one needs the licenses to talk about it that way. That's the reason I stopped at sector. But I can just add that for investors to invest in these sectors, those who are knowledgeable and therefore they want to invest direct, I think large companies whose balance sheets are not stretched. The stretch of the balance sheet is normally looked at from the point of view of how much of debt they have as compared to their equity and reserves. Okay. And similarly, how much profits that they have versus the interest outflow that they have got.
Yeah.
Okay. Lower the debt and higher the margin that they have of profit versus interest payments, the more the chances that they will survive.
Yeah. Also, like banks, let's say, in terms of what sectors they are leveraged on or exposed on highly, right? Like if they are exposed to
banks, I would be very cautious about taking an exposure.
You'd be cautious about, sorry?
About taking any kind of an exposure to banking and finance companies. It is almost like, it's a landmine. That sector is like a landmine. You don't know where you put your feet and you might get blown up.
Wow. It's crazy. I feel like no one could have predicted this. I mean, the people predicted some form of a slowdown or recession, but something from a place of pandemic, which accelerates where we are heading towards.
But you know what? I'll send you a link. This was an article that I published on 31st December 2008, 12
Oh,
years
wow.
ago.
Okay. Okay.
Because I had this habit of a New Year article, and that's why I remembered the date as 31st December. For a long time, I had this habit of a New Year article, and then when you send the New Year greetings, you attach this article to it.
Okay.
That article, the title was Recession 2020.
Really? Wow.
And honestly, the reasons that I had given there had absolutely no connection to whatever happened now. Absolutely no connection.
Yeah.
Okay.
Yeah.
But it was just that one had that hunch. It was more of a prognosis rather than a structured kind of a thing.
Hmm.
And it was more written as, that post the great financial crisis. So I said that, look, now your financial crisis is not going to lead to a recession. And then I got on to which countries will get out first, which again turned out to be true. I said US will be out and Europe will keep growing, which is what exactly happened. And
Hmm.
then I said, now don't worry about recession now, worry about recession in 2020.
Hmm.
And the way the Indian economy was shaping up, I was telling myself that, look, the prognosis that I had seems to be coming true, at least in India. But this COVID is like, it has delivered a bumper harvest in terms of how the forecast has worked out, where the
Yeah.
recession might actually spread to the whole world.
Yeah. It's crazy. Anyway, Sundar, thank you so much for doing this.
My pleasure,
And
Anirudh.
yeah, and would absolutely love for you to be in touch. And
Yep.
by the way, for those of you interested or listening in, Sundar also has a course on Masterlife called Learn Financial Investing in 30 Days, where he covers a lot of these concepts and also uh, philosophies in some sense on how to think about financial investing. So I think that's really cool. And Sundar, thank you so much. I look forward to seeing more books from you, hopefully,
Oh,
if you
yeah.
have the bandwidth or the mind space to write more.
Yes, yes.
But
Thank
thank you
you.
for today.
Thanks.
Sundar?
Yep.
Hello?
Yeah.
Hello? Sundar?
Yeah.